Did this actually just work? Am I live on TikTok right now? Oh, we are live on TikTok. Oh shit. All night long, let me see that. We're done like a truck. I was like, what? Yeah. Wait, what's the title to the TikTok live though? I don't even know what the title is, bro. I got truck. All night long. Somebody comment. Somebody comment real quick so I can see it pop up on my computer, bro. Hey, so who wanna learn how to day trade, bro? I'm giving a free course right now on live, bro. Hey, what's good, KM Trades? See why the comment not popping up on my computer, bro? Oh shit. I'll take the free course. How long you been trading, bro? Okay, wait, I just did it. Where'd it go? Bro, I just had it up. Fuck. Let's close that. Continue, bro. You're already logged in. Okay. Oh, it's something I gotta open a browser. Let's keep that up there. Let's move this over here. About 6 months now. Damn, so you know what you're doing already, then, bro. My course not even gonna help you for. Well, actually, it will help you, to be honest. But like, I want like a complete beginner, bro. I can give you a free course right now, though. So I'm pretty sure. Let's talk about trading, right? So what? So what? I'm not profitable. I got you, bro. So what have you been learning so far? Who have you been learning from? In fact, not yet. What have you been learning so far? That's a better question. Let's pull up my TikTok on my computer, bro. So I can read my own chat from here. Cause Streamlabs wanna act weird, bro. Oh wait, no, it's popping up now. No, every time I close that shit, I go back away. Let's do this again. I watched TJR Bootcamp for the basics and then just learned by myself in TikTok videos. So what do you think you struggle with the most? I don't need TikTok Studio no more. I can get that off the screen. Check out all my AI robots, free coder. Nobody wanna check you out. Nobody wanna check that out, bro. Get your bitch ass on somewhere. Alright, little boy. Let me just block that real quick. I can't find a strategy, and when I do, I don't stick to it, and lost because I overtrade, just revenge trading and not having a strategy. Okay. That's what I want you to do. Okay, wait. So, watching TJR, have you been trading for value gaps? Were you trading supply and demand from watching TJR? I think TJR trades for value gaps. So, what have you been trading then? Like, what's the foundation of the strategy you've been using? Oh, my screen keeps blacking out and coming back, bro. Break above previous session highs, wait for reversal, and then confirmation and continuation. So what do you use to draw level? Okay, I'm not even gonna ask you that. Everything you know about trading, forget it now. Okay? Everything you know about it, forget it. Let me know when you erase it out of your memory. Go on this all erase. Alright, that's what I'm talking about, my boy. Alright, so day trading 101. Let's go to a blank chart. Let's click on one of these IC markets. Blank chart. Day trading 101. Okay, so you know this. We have trading view. You know how to use the tools and all that stuff. I'm assuming you know how to work trading view. Okay. Day trading 101. Here is trading view. Inside trading view, you have all these different financial markets. You have options trading, bonds, indices, economy, crypto, forex, futures, funds, stocks, etc. Okay? Everything that I'm about to explain with you, everything I'm about to explain to you cross correlates to all of these different financial markets. So what I'm about to explain applies to forex trading if you want to trade forex. It applies to futures if you want to trade futures. It applies to stocks if you want to trade stocks. It applies to options if you want to trade options, so on and so forth. This is universal across all financial markets. Okay? Forex, yes. Okay? So, when you trading is a financial market. Okay? Forex trading is a financial market. Just like any other market. Financial markets, for every buyer, there has to be a seller. For every seller, there has to be a buyer. If there is no seller, then there can't be a buyer, and vice versa. Okay? Understanding that the market is never just going to go up forever. Okay? Market is never just going to go up forever. Reason being is because if the market just went straight up forever, that means anybody could buy here, 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 so on and so forth. Buy at any random given point in time, and by default make money because the market is just always going up. Allegedly. Okay? So that makes no sense. That's unrealistic. That's why the market never goes straight up. The market moves in what we call trends. We have bullish trends and bearish trends. Bullish trends consist of higher highs and higher lows. Look something like this. Bearish trends consist of lower lows and lower highs. Something like this. Yes. Okay. If you don't know what bullish means, when you hear the word bullish, think of buy. Buyers are in control. Think of up. When you hear bearish, think of down. Bearish means sellers are in control. Bearish means down. You have bearish trends, you have bearish markets, you have bearish candles. All of those just means sell side. You have bullish trends, you have bullish markets, you have bullish candles. All of that just means buy side. Okay? So the market moves in waves and consists of higher highs and higher lows. That looks something like this. Let's just annotate on the chart. HH represents higher high. HL represents higher low. Okay, this is how bullish trends form. Right? If the market is going up in an upward direction, it's not going to just go straight up. It's going to move in this kind of wave pattern where you see higher highs and higher lows. Just because it has to stop out the people that buy at bad times. See, this is what I know. Yeah, I know. I understand that, but I got to go over everything. Okay. So, the reason why the market moves against these higher highs and higher lows is because people that are buying here, price needs to take them out at some point in time. People that are buying too late, price needs to take them out at some point in time. That way, the market is there. That way, buyers and sellers are all getting in. Think about it like this. Okay, I'm not gonna do that explanation. We're just gonna leave it like that. All right, market moves in higher highs and higher lows. This is what a bullish market looks like. And bearish market just looks opposite of the bullish market. Instead of having higher highs and higher lows, we have lower lows and lower highs. Okay? So LL for lower lows. LH for lower high. This is what a bearish market looks like, right? Just opposite of bullish market. So we get all of this, okay? It's important to note that a bullish market doesn't go bearish until price takes out the most recent higher low. That confirms a reversal. The reversal doesn't start here. The reversal doesn't start here. The reversal doesn't start here. The reversal is not considered a reversal until price takes out a previous higher low. That is an important thing to know. Because people may be trading up here and say, I'm trying to catch a reversal. People be trying to take sales here. I'm trying to catch a reversal. People trying to take sales here. I'm trying to catch a reversal. In theory, that is just a potential retracement for a trend continuation to make a new high, just as it did here. People that are selling here, I'm trying to catch a reversal. They all getting taken out. People selling here, I'm trying to catch a reversal. They all getting taken out. People that are selling here, I'm trying to catch a reversal. They finally get a win on a reversal. But how many times are you going to lose trying to catch a reversal before you finally get that one win? Right? So it's important to note, when you're trying to catch reversals, you don't look for the reversal until the reversal already confirms. A reversal isn't confirmed until price takes out the most recent higher low, looking left. Okay? You follow me? You follow me here? Double tap the screen if you're following me. Alright, so now that we understand that, trading is a game. Okay, think about trading as a game, right? A game of probability, a game of chance, a game of something likely to happen versus something that's unlikely to happen, okay? So, actually, before we get into that, let's talk about multi-time frame analysis. Each time frame, which you see up here, daily, 4 hour, 1 hour, 30 minute, 50 minute, 5 minute, 1 minute. Each time frame tells its own story, right? Each time frame has its own market structure. So let's just scroll. Let's just look down here for a second. In the 1 hour chart, look using this example here, where we have a bullish market going to a bearish market, and then a bearish market going into a bullish market, right? Let's just fuck, bro. Right? Using this example here, let's apply this logic to, hold on. This is where we shift bearish. This is where we shift bullish. Right? Let's use this logic on the real charts. So here, the 1 hour time frame is specifically bullish. How do I know? Because this is the price action that we see. Does this look like this? Yes. It's a bullish market. Let's go to the 4 hour. Are we bullish or bearish here? We're bullish here as well. How do I know? Does this look like this? Yes. Okay. Let's get into, actually, we're not even going to use current price. We're going to use previous price action. Okay, let's look at this structure here. Because I needed to not just be bullish. I need to be bullish and bearish. And that was just straight bullish. So looking at this price action all the way over here. Okay, we're bullish here. Creating these higher highs and higher lows. Guess what happens when we took out the most recent higher low? Price shifted bearish. So let's actually make it a little bit neater. Alright, boom, 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 boom. This was the most recent higher low. This higher low got taken out. This would trigger the reversal. And then price started to sell. Then let's follow price action to the downside. Guess what we have down here. Right? Lower high got taken out. This triggered a reversal. Actually, it didn't get taken out until here. Because it's about candlestick closures, not these wicks. We in these wicks looking at closures. This was when the candlestick closed above this previous higher low to the left hand side. That's when the reversal happened. Looking at price close above here, what do we have? A reversal. Okay. How long have you been trading? I've been trading for almost 5 years. So let's backtrack a little bit. Let's go back to this price action here. This is the bullish structure on the 1 hour time frame. And look at this on the 4 hour time frame. Where did it go? This is bullish structure on the 4 hour time frame as well. Let's look at this on a 5 minute time frame. On a 5 minute time frame, what did you see here? We have bearish structure just off of this price action alone. 5 minute time frame here was bearish. Reason why I'm explaining this is because I want you to understand that you can have time frames can tell different stories. Just because we bullish on the 1 hour during this time right? Doesn't mean the 5 minutes is going to be bullish at the same time. Doesn't mean the 1 minute is going to be bullish at the same time. Doesn't mean the 4 hours is going to be bullish at the same time, right? Each time frame tells its own story, so you must treat each time frame as its own price action. Okay, you understand that? What time do you trade? I trade London session. Yes. Okay. What do you recommend for a beginner? Like, where do I start? You can start right here. I'm doing a completely beginner explanation of everything right now. So you complete beginner, like, you know nothing? All right, but not much else. All right, I'm gonna start all over from the very, very beginning. I'm gonna go complete beginner, Forex 101. Let's go to the. Let me sit up because it's about to get serious. This is what I wanted. I wanted a beginner, a complete beginner. It's about to get serious. Let's put my gum out so I can talk and you hear me too. I just low-key started learning from TikTok and I feel like I understand, but I think it's easy. It is easy. It's very, very, very easy. It's easy once you get the hang of it, but it's not easy when you get losing all the time. I don't want to be overconfident. Yeah. Overconfident is the thing, but like, you should be good, bro. All right, so how often do you trade? Every day, Monday through Friday. I'm about to go complete beginner. So if you don't know nothing about trading, it's your first time coming across somebody that day trades, I'm going to go over complete beginner and everything from in detail. I'm also beginner, by the way. Okay, I got you right now. Trust. This is going to be the only live stream you ever need. You can screen record this. It's going to be pretty long, what I'm about to tell you, right? You can screen record it or whatever the way to be. I don't really care. I'm not somebody that gatekeep, okay? So I make money off trading. I don't need to make money off of you. You know what I'm saying? So let's go complete beginner. Here, yeah, tradingview.com. If you don't know nothing about TradingView, if you don't know nothing about trading, first thing you're gonna need is a TradingView account. It is free. You don't need to purchase the TradingView features to learn how to day trade. You can use the free account. I've used the free account even though I make money off of trading. I'm sitting 2.7K in profit and I still don't even pay for the membership, right? You don't need to pay for TradingView to become profitable, okay? TradingView. Once you load up TradingView, sign up with an account. Once you sign up with an account, you're going to see a watch list over here. I want you to delete everything that's in that watch list. Okay? We're going to make a brand new watch list. Okay? But inside TradingView, this is where you're going to find your financial markets. You're not going to trade here. This is just where you're going to look at price action. Just because this is the most common and it's easy to navigate. Right? So, TradingView. Going to go to products, go to super charts. This is where you're going to find all your charts. This is my watch list here. You could develop your own watch list or just copy my watch list if you want. This watch list is the things that I trade. I personally trade in the Forex market or on the Forex platform, but I do trade pairs like NAS 100 or US 30. Those are futures or indices, right? But I trade them under the Forex platform through my broker. So NAS 100 is the same as NQ. So if you trade futures, NQ and NAS 100 is the exact same thing. They are both the NASDAQ. NQ is the same as MNQ. Oh shit, you can't see my watch list because my camera in the way. Oh shit, bro, my bad. Okay, boom. So I trade NAS 100 and I trade, which is the same as NQ, and I trade US 30, which is the same as YM. That is just a Dow Jones, but it's just different names because it's under a different platform, meaning it's under indices and not under features. I made it in 2 days. Should I buy my first eval account? I also have a couple of months learning basics. Is paper trading? No. It doesn't matter how much money you made paper trading in 2 days. It's about consistency. If you could do it in 2 days, but you can't maintain those results, you should not be buying the eval. But that's a topic for a different day. Right now, I want to focus on beginners. Okay. I know you may watching other people, you may see them say, "Oh, I only trade NAS 100," or "I only trade this," or "I only trade that." Right? It's important to diversify your pairs. Right? I'm going to tell you how important it is to diversify your pairs right now. It is important to have more than just one, two, or three pairs here because you want to focus on the quality of the trade, not necessarily being just in a trade. The market moves in cycles. You have me, I like to call it consolidation, expansion, retracement, reversal. Okay, you might not understand what that is just yet, but just bear with me. Other people might call it not consolidation. They might call it accumulation, manipulation, distribution, whatever. That whole shebang. Okay, same shit, different names. But because the market moves in cycles, just because it's your session doesn't mean it's a high probability trade. Just for that session, it could just be in a retracement phase. Now you're taking a lower quality trade, trying to trade in that session because you're trading a counter trend trade when it's just setting up for another session later on. But because that's the only thing you trade, you're trying to force trades in that counter trend price cycle, right? So to avoid taking the lower quality setups or the counter trend setups, diversify your pair and diversify your watch list and only trade stuff that are pro trend. Only focus on the high quality stuff. If any, like all of these watch lists here, I don't look at all of these through the whole time I'm trading. I've picked two out of them, put my top two, top three, and that's what I focus on. Okay, so that's why it's important to diversify what you actually trade. That way you're not taking low quality setups. Now let's get into trading view. Okay, here to the left hand side, this is where you see all your tools, right? This is the tools you use to actually draw on the chart and do technical analysis. These are the tools that I favorite. These are the main tools that I use. It's in this favorite bar here. You don't need all of these. I have a lot of these marked up for teaching purposes, but you don't need all of these, right? Really just need the rectangle tool, the line tool, to be honest. That's all you really need, okay? And the Fibonacci tool if you want to use fibs. I use fibs. So rectangle tool, line tool, and Fibonacci tool. Oh, you need long and short position as well. So I'm going to show you where to find all that. The second one from the top on the left-hand side is your trend line. Press the right arrow to the right-hand side. Go all the way down to horizontal line. Put a star next to it. You can use the trend line to point at stuff. That's what I do. Or the arrow tool to point at stuff. Other than that, go down to Fibonacci. The third one down. Fibonacci retracement. Start it. Okay. Go all the way down to the fifth one down. Forecasting. I didn't mean to do that. Press forecasting and measurement tools. Press the little arrow to the next to it. Press star long position and short position. This just what you use to paper trade, right? To put your position on the screen to see it. And at the bottom you have your measure price range. This is just measuring how big a move actually is. We can get into that later on. I'm just helping you set up your trading views for now. Okay. Other than that, what I did rectangle, I did line, I did fib, long position, short position. That's all you really need in price range. So helping you set up trading view, start all of those, and you won't have this kind of bar here. That's all you really need. Okay. Now let's start talking about technical analysis. The market, the Forex, everything I'm about to explain to you right now cross correlates to all of these different financial markets here. Trading view, you can access any kind of financial data when it comes to technical analysis, when it comes to Japanese candlesticks, like stocks, funds, futures, Forex, crypto, indices, bonds, economy, options. Those all these names here. I specifically trade Forex, but the way I trade can get cross correlated to all of these different financial markets here, but we're gonna stick to Forex for now, just to keep it simple. You trade lock on your phone. Your server is dependent on what broker. So your broker should have his own server. So whatever broker you're using, that's their broker. That's what you type in for server. If you don't have a broker just yet, go find a broker and then open up an account with that broker, and then it will tell you what to put for Trade Locker. Now that we here, let's talk about time frames. So here to the top of my trading view, you see my time frames. The D represents daily time frame. 4H is 4 hours, 1 hour, 30 minute, 50 minute, 5 minute, 1 minute. These are the time frames that you really need. You don't need all of these. I just have them up there because I just been having them up there forever. But you really just need the daily, 4 hour and 1 hour, 5 minute. Daily, 4 hour, 1 hour, 5 minute. Press the thing right over here. Put a star next to all of these. daily, 4 hour, 1 hour, 5 minute. That's all you really need. Okay. Now that we understand that, we have Japanese candlesticks here. Also, you can view stuff like the line chart and all this other different shit. You don't need none of this shit. Okay, this is all irrelevant. All you just need is Japanese candlesticks and leave it there. Okay. Still basics, setting up, helping you set up trading view. Now let's talk about what trading actually is, because some of you might not know, and if you do know, I'm going to give you a recap, a refresher. Okay, trading is Forex trading is trading the exchange rate between two different countries' currency. Okay, so you're trading the exchange rate between two different countries' currency. Inside trading, you will always have a pair. Let's go currency pair. There, in each pair, in order for you to trade, it has to be a pair. You can't trade euro by itself. You can't trade dollar by itself. You can't trade that stuff. It has to be one country's currency compared to another country's currency, and you're trading the exchange rate between the two. So, let's go to currency pairs. Let's go to images, and let's go to Euro USD, for instance. This is a currency pair. It's important to note. Well, it's not that really important, but I'm just going to tell you just so you can know. The value of the first currency, which is always the base pair. The first currency will always be a base pair. So if I'm trading EUR USD, EUR Euro is the base pair. If I'm trading GBP USD, GBP is the base pair, so on and so forth. Right? The first pair is always your base pair. The second pair is always your quote pair. Your base pair is always valued at 1. So for one, this pair is basically saying for 1 euro is equal to X amount of dollars. So in this case, it says Euro USD 1.1302. That's just for 1 euro. For 1 euro dollar is equal to 1.13 US dollars. So that's what that means. Okay, and this number changes. As this number changes on TradingView, that will be this number here. This number is going up and down, up and down, up and down, so on and so forth. That is what this number is. Okay, you don't hearing numbers. Don't get scared about numbers. Okay, you don't really need to know how to do math to be a fucking profitable trader. Okay, just scared because some people don't like math. You don't need math to be profitable. Okay, there are tools to do all the measuring and do all the math and shit for you. So in the currency pair, you always have a base pair and a quote pair. Base pair is always valued at 1. Your quote pair which will be the number to the right hand side of TradingView. That's what that number will be compared to. Okay. So you are betting, allegedly, that one pair is going to get stronger as opposed to the other pair, as far as the value of that dollar. So if the US dollar is gaining value, I mean this number is going up, that means this pair itself should be going down because USD is stronger than Euro, which will result into the Euro dropping on the chart. Okay, and if USD is losing value or Euro is gaining value, then it's vice versa. Are y'all following me so far? Or is this too beginner? Is this too beginner or are y'all following me so far? Is what a good thing or a bad thing? Is your USD? I'm following. All right, bet. All right, so also let's go back to the trading view. Here on this chart, all these black bars are just candlesticks. Okay, these are what we call Japanese candlesticks. You have bullish candlesticks, you have bearish candlesticks. Currency going up or down, it doesn't really matter. As long as you're on the right side of the market, you will be potentially making money. So if I'm in a buy and the market is going up, I am making money. If I'm in a sell, the market is going down, I am making money. As long as it goes higher than the value that I bought it at. Think of it like a shoe. A Jordan released a bunch of shoes. A Jordan released 10 pair of shoes, right? And you bought them for $220. And then they sell out, but people still want the shoe. That means the value of the shoe goes up because you can't get them nowhere else besides off of the 10 people that bought the shoes. So the value of the shoe goes up. Now you can sell that $220 shoe for $400 or $500, etc., depending on the market for that shoe and how many people want that shoe. So if you buy it and it goes up in value from the price that you bought it in, when you eventually sell, you make money. Okay, and vice versa. If you're selling something and it's going down in value, The lower you sell it, the more money you make. So it doesn't really matter if currency is going up or down. It doesn't really matter. As long as you're on the right side of the market, then you should be good. Is it possible to start with $20? Yes, it is possible to start with $20. But we can get into that later on as well. So let's continue on. These are all candlesticks, right? Japanese candlesticks. Let's go over what a candlestick actually is. So if you want to screenshot this for currency pairs, you can screenshot it, so on and so forth. But now we're going to go on to candlesticks. Teach me how to get rich. I'm not rich myself, bro. I can't teach you how to get rich. I do make some decent amount of money, but like I'm not rich though. Forex candlesticks. Why don't you have colors? Because I don't pay attention to the colors. It doesn't really matter to me. I think the blacks look cleaner. Just to be honest, but I was trading for a long enough time to know which candles are bullish versus which candles are bearish. So I don't need the colors to tell me which ones are bullish or bearish. I could just see them and know which ones are bullish or bearish. Do you recommend Forex for beginners? All of them is equally as hard. There's not one that's easier than the other because it's beginner versus advanced, right? They're all equally as hard, so it doesn't really matter. Here you have candlesticks. So each one of these black bars on the screen represents candlesticks. I'm gonna make mine a different color just so y'all don't get confused. Let's go blue and red. So each one of these are candlesticks. Each one of these candlesticks represent whatever time frame you're on. So if I'm on the 1 hour time frame, that means each one of these blue or red bars represents 1 hour of price action. Or price action, just how much the price changed within that hour. So if you look on the right hand side, see 21 minutes 34 seconds. That is how much time is left before this 1 hour candlestick close. If you look at the bottom right of my monitor, you see it is 12:39. 39 plus 21 minutes will put you at 1 a.m. So that means every hour you will see another hourly candle close, so on and so forth. Thanks for the harmony, bro. If I go to the 4 hour time frame, you see the chart change a little bit. That's because this now means that each one of these candlesticks represents 4 hours of data and not just 1 hour data as it did here. Right? So let's get back into the candlesticks. For when vocabulary, bullish and bearish. This is your vocabulary words. Okay? Whenever you hear bullish, think buy. Whenever you hear bearish, think sell. Whenever you hear bullish, bullish think buy, bearish think sells. There are bullish trends, there are bullish candles, there's bullish price action, there's bullish chart patterns, there's just bullish. Whenever you hear bullish before anything, just think buys. Keep it simple. Whenever you hear bearish before anything, just think sells. Okay? For every candle itself, you always have a opening price, a closing price, a high, and a low. No matter what candles it is. If it's bullish or bearish, you will always have a open price, closing price, a high, and a low. Open price, closing price, high, and a low. Okay? A bullish candle just means the closing price is higher than the open price. The bearish candle is opposite. So whatever I say about bullish, just think opposite for bearish. Whatever I say about bearish, just think opposite of bullish. Okay? So for every bullish candle, that just means the closing price is always higher than the open price. As for bearish candle, the closing price is always lower than the open price. But the highs will always be highs, the lows will always be lows. Okay? You follow me so far? I need to make sure I'm not leaving nobody behind. If stuff start getting confusing, let me know because it's going to get a little bit in detail. Okay? So, the highs and the lows, these are wicks, right? These lines are wicks. So we have a high in this upper wick, we have a low in this lower wick. We have a high in this upper wick, we have a low in this lower wick. Wicks, think of wicks as footprints in the sand. This lets you know that how high or how low price has traveled before closing. So if this bullish candle right here opened up at this price point, say this price point is 1.00, meaning just this price point is just $1, and it went up, it went up, it went up. Say it went up to $5 in the 1 hour, but before that 1 hour candlestick closed, it retraced back down to $3. Then it closed here at the $3 price point. It's showing you that price at some point within this hour reached up to $5 in value before closing at this $3 mark. So think about these wicks, the high upper wick, which is the high, the low wick, which is the low, as footprints in the sand. Footprints in the sand when you're walking on the beach. If you're walking on the beach and you look back, you will see where you came from. So these wicks is just showing you where price came from. So price was up here, leaving footprints in the sand, and stopped here. Price was down here, leaving footprints in the sand, and stopped here, or this way. So down here and closed here, up here and closed here. Right? That makes sense. Do you understand what the candlesticks? Do you understand the open and close, the high and the low of a candlestick? I didn't understand. Okay, what part did you not understand? Did you not understand what I said about the highs and lows, or did you not understand about the opens and the closes? So you think about the opening and closing. Okay, so let's use a real candlestick on a chart to give you an example. Let's go to the 1 minute chart. Let's reset. Let's zoom in. Right here, you have this candlestick closing in the next 1 second. This candlestick literally just closed. This is blue. This is a bullish candlestick. Okay, it's about a new candlestick about to open. It doesn't open yet. Just wait, and you're gonna see the timer here starts again. And 42 seconds left inside this candlestick. Okay. Actually, let's do it on this chart here. So this is 1 minute chart. This looks pretty bad. Let's look at a cleaner. Okay, yeah, this looks better. So this is a 1 minute chart. That just means for each one of these red or blue candlesticks represents 1 minute of data. As you can see, this is the timer before these candlesticks open and close. For a bearish candlestick, that means the closing price is lower than the open price. So if the open price opened up here, if this was the opening price and this was the closing price, that gives you the bearish color. This gives you a red candle just because the closing price is lower than the open price. The next candlestick will always open where the previous candlestick closed. Okay, so as you can see in the red candle, which is a bearish candle, which is a selling candle, that's why it's going down. The closing price down here is lower than the open price, which is up here. But as you can see, once this candlestick closed, the next candlestick opened right next to it, and it ended up being a blue candlestick. Why is it a blue candlestick? Because the closing price is higher than the open price. So this candlestick opened where the next candlestick closed at, and inside 1 minute it closed all the way up here, showing you, which makes it a blue candlestick. And then guess what happens next? The next candlestick opened up right where the previous candlestick closed at once again. So this candlestick opened over here. The close is higher than the open, meaning the close, meaning when this timer runs out, the candlestick will close. 30 seconds. And then once again, boom. The next candlestick open where the previous candlestick closed at. Now we're going to look at this candlestick live. Okay, 20 seconds left before this candlestick closed. You see it's forming. This candlestick is moving because this candlestick is actually open. We have 13 seconds before this candlestick closed. And as you can see, the next candlestick will open wherever this candlestick closes at. So 5 seconds. And it closed up here. Once this candlestick closed, guess what? Our next candlestick opened right over here, and it opened up red. Reason being, because it opened up here and it pushed down. Once this candlestick pushed down, that means it's the current candle the current price of this candlestick is lower than the open. So it gives you that red color or that bearish color. If this candlestick the value of this candlestick, if price goes higher than the open, it will change to blue. As you can see, it just did. And now it's a little bit blue. Let's see what happened with this candlestick. We got 19 seconds left inside this candle. It's red again because the value of this candle is lower than the opening price. And now it's higher than the opening price, so it turned to blue. We have 7 seconds left to see how this candlestick closes. Is it going to close blue or red? 1 second, it closed red, meaning the closing price is lower than the opening price. If it opened up here and closed down here, get you that red candle. And then once again, the next candlestick opened where the previous candlestick closed. Now, did this example make sense of opening and closing of candlesticks? Meaning each candlestick represents 1 minute of data, and every minute a different candlestick opens and closes. Yeah, so is it making sense now when it comes to opening and closing the candlesticks? Each is 1 minute. Yeah, so every time you see this time reset, see it resets at 1, 0, it's going to open up again. Now it's 59, 58, 57. It's going to keep doing that. And each of these time frames represents the timer will change here. And the candlesticks will change as well because it represents more data. So instead of going to 1 minute, let's go up to the 5 minute. See? Now the candlesticks look a little bigger because I'm on a higher time frame. Now in the last three, if the last 3 candles were going up, that will make this 5 minute blue. You see? So let's say, let's go, it's 12:49 a.m. down here. Let's go to 12:45. 12:45 was 45 with this candlestick here. Let's clear the chart. Let's mark off 12:45. 12:44, 45. This was 12:45 right over here. You can see 1, 2, 3, 4, 5. This 5 minute candlestick just closed because it's 12:50 now. The 5 minute candlestick closed up here. But if I go to the 5 minute chart right now, you will see that this 5 minute candlestick opened here because this was the previous 5 minute close. So let's show you, and then boom, here it is right here. Let's just drag it more left so you can see it, extend it out. And then I did 1 hour, 5 minutes. There we go. Boom. See how they add up, and 5 1 minute candlesticks will show you how the 5 minute candlestick looks, and 12 5 minute candlesticks that will show you how the 1 hour candlestick will look, so on and so forth, because all of these time frames are in sync with each other. Just that the difference in time frames just showing you how much time is left before that candlestick close in that time window of data. No, we're not even getting into that yet. We're not even getting into that yet. You're going a little bit too fast. I just want to make sure you understand what a candlestick actually is. Understand the opening price, the closing price, and what the high and the low is. Just for percent of saying. So as you can see, let's go back to 1 minute chart. The wicks, meaning the black lines that is above and below the body. Okay, the red, what you see is the body. The blue, what you see is the body. The black lines are the wicks. So a black line below price is a low. The black line above price is a high. Okay. And that just like, think of it like the beach, like I said before, just 4% of sand. So as you can see, price is now here. So let me show you how it works. We're gonna wait for this candlestick to close in the next 12 seconds. You're gonna see when the next candlestick opens, it's gonna go either up or down, and it's gonna leave a black line trail. So let's watch and wait for it. 1 second. Candlestick just closed. New candlestick opened up here. Let's see if it pushes up or down first. It pushed up and down, but it happened really fast because it's a low time frame. So it pushed down first, left a black line. Then it pushed up, and once it pushed back down, it left another black line, showing you that footprints in the sand, meaning price was up here at some point in time, meaning it walked this deep in the sand at some point in time, and it left a trail, and now price all the way down here. If it pulls back, it will leave another black line. See, showing you how low price was before pulling back, and there's 25 seconds left. Eventually, this candlestick will close. So it's going to show you where that candlestick closed at. So let's wait for this candlestick to close in the next 10 seconds or so. Yes, the wicks do matter. 1 second. And it closed down here. Then guess what? The next candlestick opened up where the previous candlestick closed at, and it's showing you the footprints in the sand once again. So before we get into anything else, though, y'all have to understand candlesticks. Do you understand now? Did I do a better job explaining? You need to focus on the whole entire thing. The opening, the close, and the wicks. The upper and lower wicks. You need to focus on all of them. Let's pull up a different chart example. Okay, this is a better one. Diagram example. So the green, what you see is the body. The red, what you see is the body. So the thick part of the candlestick is the body. The small lines at the top and the bottom of the candlestick is what we call wicks. If it's below the candle, it will always be a low price. If it's above the candle, it will always be a high price. And that just tells you where price traveled before closing inside that time frame. Why aren't you looking at volume in RSI? Because I don't need an indicator to tell me where price is going to go. Indicators are lagging. I've been trading for 5 years. I don't need an indicator to tell me how to trade, bro. What does it mean when the candle opens and does have a wick at the top? It just means that price went up at some point in time inside that time frame and then went back down, leaving that trail or leaving them footprints in the sand. So do we understand candlesticks? What about if it's flat and it doesn't have a wick? That means price never went up. So if it's flat and it doesn't have a wick, meaning the opening price, just say price never went up, but just went straight down and then closed, it just never made a top wick. Or it just never made a bottom wick. That's all it means. What about when the candlestick is high but it closes? Do you use CRT? I don't know what CRT is. What about when the candlestick is high but it closes? Isn't it supposed to go up? We're getting a little bit too far ahead. Talking about green. We're getting a bit too far ahead. We need to understand the bare bones of candlesticks. We're going to get into how to predict where it's going to go as far as going up for the future or go down in the future later on. But right now, I just need y'all to understand candlesticks has opening price, closing price. Bullish candlestick just means the closing price is higher than the open price. A bearish candlestick just means the closing price is lower than the open price. Both examples will have a low price and a high price when it comes to the wick, showing you where price was before closing in that time frame. That is it. The wick represents a trail, showing you where price was before closing in that designated time frame. So let's do a little. Let me go back a little bit. Remember what I said. Remember I said that bullish think buys, bearish think sells. When you see a bullish candlestick, think buys. When you see a bearish candlestick, think sells. When you see bullish price action, think buys. When you see bearish price action, think sells. Okay, you follow me? So do you understand the difference between bullish and bearish? Yes. Okay. Now that we understand candlesticks, let's get into trends. Trends. Bullish goes up, bearish goes down. Yes. Let's get into trends now. The market will never just go straight up forever, right? How do you feel about December price action? I treat December price action just like I treat any other month. Um, the market will never just go straight up because this is flawed. In theory, if the market would just any financial market would just to go straight up, then everybody will become rich because anybody could buy at any random price and make money as they hold long enough for price to go up. Okay. At the end of the day, trading is a market, meaning for every buyer there is a seller. For every seller there is a buyer. If there is nobody on the other end of your trade cannot be executed. Think about clothes. If nobody was wearing clothes, can't nobody sell them. It goes for any kind of market. If there was no consumer, there would not be a market for that product or that thing or that whatever it is. So for every person that's buying something, there has to be somebody in there selling it. That's why the market can never just go straight up because somebody has to lose. Okay, did that make sense so far? Yes. Yes. Okay. Okay. So just because the market is going up in theory, well, yeah, in theory, doesn't mean it's going to go up forever. Okay, the market moves in what we call waves. You identify a wave by what we call a trend. Now you have two different kinds of trends. You have bullish trends and you have bearish trends. I'm going to go over bullish trends first. Bullish trends consist of higher highs and higher lows. I'm going to draw it out on a chart. Looks something like this. Now, I'm doing a line just to make it easy, but it will look something like this, but with candlesticks instead. So let's look at it here. So this is my example, which is pretty clean. This is the chart example based off of the candlesticks. It just looks like this. Let's make it thicker so you can actually see what it looks like. It looks like this. So when you're trading candlesticks, you don't need to be specific on each individual candlestick. Like you need to be zoomed in super close to look at the open and close, the body, the wick. Like you don't have to do that. Look at the candlesticks as a whole because the candlesticks it's as a whole tell a story, not each individual candlestick. Okay, so this is what it will look like on a candlestick thing idea. But I'm doing use the line for teaching purposes. That way you can understand it instead of me trying to draw a bunch of candlesticks to show a bullish market. All right, so this is what a bullish market will look like. Inside a bullish market, you will see higher highs and higher lows. I'm going to mark off what a higher high is. I'm going to mark off what a higher low is and explain to you why they are called higher highs versus why they are called higher lows. So I'm going to use abbreviations for all of these. HH just represents higher high. HL just represents higher low. Okay. Let's say hypothetically speaking, price action starts right here, right? And price push ups and creates a high point, meaning a peak, right? This is a peak in price, a high point, a pivot point, right? Then price pulls down a little bit. You might be wondering, well, why is prices pulling down? Because the market is never going to go up forever. Like I said before, if the market goes up forever, anybody could be buying at any random given point in time and make money. So the market has to come down at some point in time to make other people lose, to take their money, to fill orders. Or the people that bought at this value are now selling up here, meaning their positions are getting taken out, setting up for potential more buy opportunities later on down the line. But that's a little bit too advanced. Just to keep it simple, price when we push up, we'll find a peak point in price and then starts to come back down and drop in value. Think about it like something going on sale, right? Something maybe getting sold at $100 and then let's say a month, 2 months in, the product is not really selling that much. It go down to 70% off. clearance, 30 down $30. That's what this looks. That's what this is. Right? Price finds a peak, then price goes on sale. Okay? You follow me so far? Okay. Now, these small moves to the downside, these have a name. They are called retracements. They are called retracements. Okay? Retracement just means once price pull back and continue. That's it. So any small move opposite of the overall direction. So the overall direction is going up. But we have small bearish moves in between. These are all just retracement. And now these big moves up have names as well. These are called continuations. Just meaning price is continuing going its intended way. Did that make sense? So let's go back here. Retracement equals pullback continuation equals break. I spelled break wrong. Can you trade without a bank account? You need to deposit money, bro. Okay, so now let's get into what makes these higher highs and higher lows. We deleted the wrong thing. Try to delete this little blue line. Okay. Inside a bullish trend, you have retracements and continuations. Same thing in bearish trends, you have retracement and continuations. Okay. This is called a higher high. Right? Once price creates a higher high, meaning price pushes up, finds a peak, price pulls down, goes on sale, and creates a higher low. You might be wondering, why is this called a higher low if it went down? Well, it's because it's a higher low simply because this start of price was a higher low. And this low technically is still higher than this low. If we just put a line here and a line here, which line is higher? This one or this one? Very, very, very easy. This line is higher than this one. So this is considered a higher low. Now, that's why it's considered a higher low. So the high side, the high part of the higher low is because this is higher than this high. The L part of the higher low, which is the low, is considered a low because this is lower than this high. So let me rephrase that. Let me say that again. So if price pushes down, meaning go on sale, doesn't go lower than the previous low, then it's considered a higher low just because it's higher than this previous low looking left, but it's lower than this high looking left. Okay, did that make sense so far? Okay, so now let's follow price. What does price do again? Prices pushes up, finds another peak, another ceiling, another high price, right? And creates a higher high. You may be wondering, why is this a higher high? It's very simple. If you put a line here at this high and put a line here at this high, which line is higher? This one is higher than this one. So that's why this is called a higher high. This high right over here is higher than this high. And then price goes on sale again, prints a higher low. You may wonder, why is this a higher low? Just because this this low is higher than this low. Put a line here, put a line here. Which one is higher? This one. So it gives the name higher low. And then rinse and repeat. Price eventually pushes up again, goes above this previous high to the left hand side, finds another peak and makes a new high. So in a bullish market, or a bullish trend, consists of higher highs and higher lows, giving you this wave pattern showing you a trend. Do we understand what a bullish trend looks like now? And what did I say about bullish and bearish? Whatever I say about bullish, what bearish should be the what? Bearish should always be the opposite of bullish. Opposite, exactly. Exactly. So whatever I say about bullish, the opposite goes for bearish. Both of them will have pullbacks in general, or retracements. Both of them will have continuations in general. Let's just make this blue so you guys know the idea that this is bullish, and bearish just looks opposite. Let's make this red. Now instead of saying higher highs and higher lows, we have what we call lower lows, meaning is a lower low is the opposite of a higher low. And we have lower highs. Now, you might be wondering, well, how is this a higher low? Easy. If I draw a line from this previous higher low and draw a line at this lower low, which one is lower? This one. This low is technically lower than this low. So this makes this a lower low because this is lower. Very simple. Then price goes to a premium, or price goes, we're going to keep it simple. Just say price goes on sale, press a lower high. How do I know this is a lower high? Because this is a high because price went up, but it's technically still lower than this high that we had all the way up here. So it will be considered a lower high. Yes. Whenever the market is going up, you want to be looking for buys. Whenever the market is going to be going down, you want to be looking for sales. Now, price makes a lower high and eventually pushes back down. Draw a line from this low and this low right over here. Which one is lower? This one. That's what gives it the name lower low. This low is lower than this low. So you have a new low. Again, price goes back up, creates a lower high. How do I know this is lower high? Because this high right over here is technically still lower than this high. So it's a lower high, and rinse and repeat. Market makes a new low as price make a low to the left hand side, right? Make a low right over here. Look to the left hand side. This low is lower than this low, so it gives it this name lower low. So do you understand what a bearish market looks like now? I need to know if y'all get it before I continue. I don't want to continue if everybody don't understand, you know. Yes. All right. I understand this. Okay. It is important to note that in order for a bullish market to go bearish, the most recent higher low has to get broken. Meaning, when I say broken, I mean price has to make a lower low. It is important to note that it has to. There's no ifs, ands, or buts about it. In order for a market to go from bullish or higher highs and higher lows to bearish, price needs to make a new low. And guess what? Okay, you got lost. Let me say it again. In order for a bullish market to be turned into a bearish market, because a bullish market will never be bullish forever. A bullish market will never be bullish forever. A bearish market won't be bearish forever. It will go from bullish to bearish, bearish to bullish, bullish to bearish, bearish to bullish, bullish to bearish, so on and so forth. Right? So it'll be buyers in control, sellers in control, 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 so on and so forth. Okay? But it's important to note that in order to spot or in order to see when a market goes from buyers being in control, which is an uptrend, to a downtrend, meaning sellers are in control, price has to make a new low with this low here, breaking the previous higher low. Until you see price make a new low below the previous higher low, then it is not. You need to see this happen for you to say to yourself, okay, sellers are now gaining control. Okay? Because this price action, this is what we call price action. Okay? This is telling you who's in control, buyers or sellers, because there will always be a battle between buyers and sellers. That's how price forms. Okay? Whichever side is stronger, that's what decides if the market is going to go up or down, the buyers or the sellers. Okay? So, an uptrend lets you know that buyers are in control. A downtrend lets you know that sellers are in control. But in order to spot a shift in power, meaning from buyers being in control to sellers being in control, price has to make a new low. Going lower, then price has to make a new low. And you will know that it's a new low if this low is technically lower than this one right over here. When this London session opens at 3 a.m. Did that make sense? So for market to go from bullish to bearish, price needs to make a new low. Okay, and guess what? It's just the opposite for bullish. Very, very, very simple. When the market goes from bearish to bullish, guess what? Price just needs to make a new high. Does this make sense? Do you have an idea what trends look like? So when the market is bullish, you will want to buy at these higher low points. So when you're looking for buys, you want to buy at higher lows. When you're looking for sells, you want to sell at lower highs. Y'all got me? When you want to take a buy, you want to try to buy at higher lows. Meaning all of these areas here. When you're looking to take a sell, you want to sell at these lower highs. Okay, so now we understand uptrends, we understand downtrends, we understand candlesticks, correct? Now let's get into, I got another vocabulary word for y'all. Pips. Pips is an abbreviation. PIPS simply means, actually it's not really simple. It means point in percentage. Right? But you don't really need to know what the fuck it means, to be honest. I just told you it just to tell you it. It's not gonna it's not gonna make or break your trading career knowing what the abbreviation for pips actually means. Okay? Think about it like this. Pips is just how we measure how big a move is in the market. So let me give you a comparison to let me give you the comparison to real life, because I try to use a lot of real life references that because people understand real life because they're living in it. If I can make a comparison, a trading comparison to real life, it'll be easier for people to understand. That's why I like to use real life comparisons. Okay, so pips is just a unit of measure of how we measure distance in a market, or how far a move either went up or down. In real life, we measure with inches, feet, yards, centimeters, miles, kilometers, shit like that. We measure mass with weight. I know some girls scared to hear the word weight, but I'm saying we measure with weight. Okay, that's how we measure in everyday life. In market, pips is just another name for inches or centimeters or yards. That's just how we measure distance on how far a market moves, either up or down. It can go up 50 pips, it can go down 50 pips, it can go up 25 pips, it can go down 25 pips, so on and so forth. Do you understand what pips are? Yes, measure distance. Yes. Now, the value of a pip is determined by a lot size. The value of a pip is determined by a lot size. A lot size is, let me see how I could put it. Okay, you need to put a lot size when you go to enter a trade. A lot size will determine how much you make or lose depending on how big a move is when it's measured by pips. There are three different kind of lot size. You have a mini lot, a micro lot, and a standard lot. For every mini lot, that is 0.01, that just means for one pip is equal to 10 cents. Okay? One pip is equal to 10 cents in that's not a mini lot, it's a micro lot. 0.01 is a micro lot, one pip is equal to 10 cents. So if I was trading with one micro lot, that is 0.01, and the market moves up in my favor while I was in a buy, fucking 100 pips, I made, actually 10, let's go 10 pips. 10 pips, I made $1. Because 10 pips times 10 cents per pip is one whole dollar. So that's what a micro lot is. A mini lot is 0.10. That just means for every pip the market moves, that is equal to 0. That is equal to $1. Okay? 0.10 for every pip the market moves, that is equal to $1. So if the market moves up 10 pips and I use a mini lot, which is 0.10, that is equal to $10. And if the market if I use the standard lot, which is 1.00, that is $10 per pip and the market moves 10 pips, that is equal to $100. So if I just say it, you're not gonna, y'all might understand it, but you're not gonna remember it. So to make you remember it, we're gonna pull up a diagram again. Forex lot sizes, and go to images, and boom, here you go. Okay, ignore nano lot. Nano lot is not a thing. No broker offers you nano lot sizing, bro. You can't get 1 cent a pip. Okay, that's too low. But here is what it looks like. Ignore the currency unit. You don't need the currency units as well either. You don't need to know this. If you want to remember it, you can remember it. Screenshot the diagram or whatever. But the currency unit really doesn't matter. All you need to know is this what is entered as, and this what is valued per pip. You need to know this because this is how you calculate your risk. This is how you know how much you have on the table to potentially make versus how much you have on the table to potentially lose. Okay? You understand how important pips is in lot sizes. Pips, P-I-P-S, that is a unit of measure. We measure in real life with distance, miles, yards, things of that nature. Pips is just measuring how far a market moved. So if I am in a trade on Euro USD, well, I'm actually in a trade in USD. That's why you see our profit up there, which is 3.1K. But if I'm in a trade and the market moves up in my favor from my entry all the way up here, that is equal to 32 pips. I use 5 lots. That's why I say it's 3.1K. 5 times 32. 50 times 32, 3.1K. But this is pips is just used to measure distance. Yes. So if the market travels up from this number, what you see here, look to the right of the screen where you see 1.16128, right where my line is at, where my mouse is at, all the way to the right. And market goes up 32 pips. That's just measuring distance on how far the market moved from here to here. So pips is just what we use to measure distance in the market, just like we use feet or square feet to tell how big a house is, or you use yards to tell how big a football field is, or you use weight to tell how heavy something is. Pips is just a unit of measure to measure distance in the market. And this is important when it comes to lot sizes because the value of a pip depends on how many lots you put towards that market. So 32 pips for me could be 3.2K. 32 pips for you could be $30. It could be $300. It could be $3. That is only determined by how many lots you use. Okay? So the value of a pip is determined by how many lots you use, but the pip itself is what's used to measure distance. Does that make sense? Yes. Your lots is the lots times your pips is how much you gamble. So if I have, we can get into it a little later. So $1 in lots, which is 1.00, that is one standard lot. That is equal to $10. Well, I'm in the United States, so I use USD, but it correlates to whatever country you're in. But the value, um, the pair determines how much that pip is worth. But just keep it simple. In this case, we're going to just keep it at each pip is worth $10 for a standard lot. Each pip is worth $1 for a mini lot. Each pip is worth 10 cents for a micro lot. You can't do nano lots with most brokers. Yes, so 3 standard lots. Oh, no. Yes, you're right. 3 standard lots is $30 per pip. Yes. Yes, you make money off of the lots. Well, you make money off of the market moving in your direction. But that is determined by how many lots you use and how far it moves your direction. So yes, 3 standard lots would equal to $30 per pip. When you hear the word per, think multiply. For this position, I use 5 lots. So that's $50 per pip. So I use 5 standard lots. That's $50 per pip. Actually, I lie. I use 10 standard lots. So that was $100 per pip.